Investing is about putting your money or savings to work for you. Investments carry varying levels of risk depending on the asset class. Savings might not always keep pace with inflation. Retail investors are individual investors who invest their own money for their personal financial goals. Insurance companies invest premiums paid by policyholders to meet future obligations. Savings refer to the portion of an individual's income that is not spent on current expenditure, but rather set aside for future use. In other words, savings is the part of an individual's income which is not spent immediately. Investing is about putting your money or savings to work for you. It's the act of committing your money or savings today with the expectation of receiving a greater return in the future. This return can come in various forms such as income. Investment like bonds and rental properties can generate regular income payment. Growth. Stocks and other assets may increase in value over time, offering potential capital appreciation. Combination. Some investments offer a blend of income generation and growth potential. The difference between savings and investment. One is that it depends on the purpose. Savings are typically funds set aside for short-term goals or emergencies, often kept in low-risk accounts like savings accounts. Investments are aimed at generating returns over the long term with the goal of increasing wealth or achieving specific financial objectives. It also depends on risk and return. Savings usually involve low risk but also offer relatively low returns, such as interest earned on a savings account. Investments carry varying levels of risk depending on the asset class, such as stocks, bonds, real estate, and others, but can potentially yield higher returns over time. It depends on liquidity. Savings are highly liquid, meaning that funds are readily accessible without penalty, making them ideal for short-term needs. Investments may have varying degrees of liquidity, with some assets being more easily converted to cash than others. It additionally depends on time horizon. Savings are typically earmarked for short-term needs or emergencies, so the time horizon is relatively short. Investments are generally intended for longer-term growth, with investors willing to wait for returns to accumulate over years or even decades. Again, it depends on protection against inflation. Savings might not always keep pace with inflation, meaning the purchasing power of saved money could decrease over time. Investments have the potential to outpace inflation, helping to preserve and grow wealth over the long term. It depends on principal preservation. Savings accounts typically facilitate the preservation of the amount saved, ensuring that the initial amount saved remains intact. Investment, especially those involving higher risk, may not guarantee the preservation of the principal and could result in losses. Beyond the two main categories of retail and institutional investors, the investment landscape encompasses a broader range of participants. Here is a breakdown of some key types of investors. Retail investors. Retail investors are individual investors who invest their own money for their personal financial goals. They may have varying levels of investment knowledge and risk tolerance. Examples of retail investors are pensioners, students, workers, and many more. Institutional investor. An institutional investor is a company or organization that invests large sums of money on behalf of other people or on its own behalf. Examples of institutional investors include pension funds. Pension funds manage contributions from employees and invest them to provide retirement income. Their focus is on long-term growth and stability. Then we have mutual funds and ETFs. Mutual funds and ETFs pool money from many investors and invest them in a diversified portfolio of assets. They offer professional management and are popular choices for retail investors. Then hedge funds. Hedge funds employ complex investment strategies to achieve high returns, but also carry higher risk. They typically require a high minimum investment and are often limited to institutional investors and accredited individuals. We have insurance companies. Insurance companies invest premiums paid by policyholders to meet future obligations. Their investment strategies prioritize security and stability to ensure they can meet claims. There is also the endowment funds. Endowment funds invest money donated to universities, hospitals, or other non-profit organizations to support their long-term operations. They seek a balance between growth and income to sustain organizations' missions. We have banks. Banks are financial institutions licensed to receive deposits, and they provide other services such as mortgage loans and individual retirement accounts. Securities and Exchange Commission ensuring investor protection.